Let's now move on, because what we've now got is something very, very popular just here now. And we mentioned this right at the beginning of our lesson today. So look, if we go back to the homework from last time, and I've kept out the question here earlier. Look, can you remember we had this question here earlier? I kept it out. Here it is just here, look. Look, can you remember the homework last time? We had a company that was thinking about doing that, diversifying. And so we've now going to start getting into what's known as a risk-adjusted WACC. And look, we said this for the homework question, and that was that the existing WACC should only be used as a discount rate for new investment projects if the business risk and the financial risk is the same. Yeah, so only should use existing WACC if everything is the same. And so that's what we said here earlier for this question. We couldn't use this because the business risk was changing here. It means that what you need to look out for the exam, it's not only the business risk. What you need to look for is either if the business risk of the new project or the financial risk changes. Financial risk we're going to see to do with debt to equity. So debt to equity is given as a financial risk. The investors will expect a different return. And that means that for this new level of risk, we need to calculate this risk-adjusted WACC, therefore. This involves what's known as ungearing and regearing beta factors. So what do we mean by adjusting beta factors here? Let's get into this adjustment here of our beta factors. So what we've got here, first of all, is this very, very long formula. And what this long formula is trying to do, it's trying to link, this is the company's ungeared beta. We've got here, look, a beta asset with a geared beta. So we've got here our equity betas there and something known as a debt beta here at the end. Now, what's important is this. In the exam, covering debt betas is beyond our syllabus. So, what you need to assume, and we normally assume it, that debt is risk-free. So, in other words, the debt beta is 0. So, this part of the formula just here, that now disappears. That goes away. So, that's going to disappear just there. And then what we're left with then here is this. The beta asset is going to be calculated taking the beta equity. This is times E divided by E plus D. And so this formula is the one we need to know. That's what we need to use here in the Module 12 exam. So the last thing I'm going to do in a second is an example before we finish tonight. But look, let's get into some assumptions, limitations here of this. So this is going to be the same as with the WACC. You have market values of equity, of debt. We assume those must be used and they don't change in the period under review. So the financial risk doesn't change when we're calculating the adjustments. We need to find an equity beta from a company that's exactly the same business, same growth opportunities, same economies of scale. Otherwise, we'd get some risk differences. That's difficult to do. That's a limitation. In practice, debt is not risk-free. As a company uses higher debt to equity ratios, that can carry a higher risk of company insolvency, the risk of the lenders not getting their money back. And it's the same as what we talked about earlier in CAPM. So back to what we mentioned earlier in our cost of capital, we said the same limitations down just there. So let's now get into a little example here on ungearing and regearing our betas. Let's have a look at the company we've got down just here. So let's say this is our company. This is our company A. And we're being told just here, we've got the debt to equity ratio just here, we're being told is 2 to 5. So let's put down here, this is going to be, let's put company A's, this is going to be financial risk. So financial risk is always to do with the debt to equity ratio. And look, you can see this must be debt. We've got here, this is 2. and then that must be equity there. That's going to be 5. So that's our company A financial risk down just there. It says the corporate debt, which is risk-free, 6% before tax. So they're assuming they're risk-free debt. So debt beta, but they don't say that. You normally assume it's risk-free anyway. Look, the debt yield 6% before tax. That's going to be our cost of debt before tax. And then look, we're being given a beta value of the company's equity is currently 1.1. And it says the average returns on the stock market are 12% and the risk-free rate is 6%. That begin capping information down just there. Fine. Let's see now what they're asking us here to do. So being asked required, what would be a suitable cost of capital to apply for the MV of the project? Now, if we're expanding the travel business, not a problem. We could use the existing here beta. That represents the risk of travel. So not a problem here. If we're doing that, expanding travel, not a problem. We can use that beta there. Here's the problem. They mention this, look. Our company A, is now proposing to invest in a commercial property project which involves diversification into a new industry. What that means in a second is step 1, we now need to find a beta of a company that works in that industry, commercial property. Because look, commercial property will not be represented by that beta there. We cannot use that beta there. What we need to do is we need to find on the stock exchange another company whose business is in commercial property. So here's company B, look, another company. Let's look. They've got their beta down just there, 1.59. So can we use that in CAPM? Hold on one second. Look at their financial risk. If you look at their financial risk, let's put down here, it's going to be company B's financial risk. It's different to ours. Look, you can see here 2 to 5. Theirs is 1 to 2. So look, you can see here 1 to 2, 2 to 5, different to ours. So what does that mean? That means in a second we need to go through some adjustments. Ungear and then regear is what we need to do. Our adjustments down just here. So look, let's go through our ungear and our regearing in a second. And then when we adjust, we are going to be adjusting as a tax rate down just there as well. Let's go through each of these steps. Let's first of all look at what's happening here with betas. So if you remember, when we started looking and discussing beta, remember we talked about HSBC. We talked about HSBC, and what we said was HSBC has got a beta of 1. So if the mark goes up by 10, you would expect HSBC also goes up by 10. So it's comparing the return from a share versus return on the market. And what makes up an individual beta of a share? We said 2 types of risk, if you remember. We said there's the business risk. So we talked about an airline. We said, look, airlines have got a big amount of fixed costs. So the higher amount of fixed costs you've got, the higher the business risk. And the financial risk, we said, is to do with the debt to equity ratio. So if you've got here a greater amount of debt to equity, so that would be a ratio or a proportion here. Either way, it means you've got higher financial risk. That's what our beta represents. So we need to think about the beta now in exam questions here. And so look, these are the tricks they can play in the actual exam. You need to look, is the investment in the same industry as ours? So is the investment in the same industry as our current business? If it's in the same business, same current business, it's going to be the same beta equity therefore. So look, let's go back to a little example here and let's put that in. So if we're expanding travel business, not a problem. We could use 1.1 there as the beta. It's the same business risk. We can use our existing equity beta. But the key point is this, look, it's not in the same industry. We are diversifying into a different industry. So look, this is going to be commercial property projects. And because that's a different business risk, that's going to mean here we are going to be diversifying therefore. So we need to use an equity beta to represent the business risk of the new industry. So look, here's the first one. Step one, we select an equity beta from a company that undertakes similar business as a new investment. So we just did that. We got the beta from company B. It was there. Look, there was the beta 1.59. Now what we next need to do is you need to take out the financial gearing of company B, and then we need to, in our company's financial gearing, that's regearing. So what's all this ungearing, regearing? Let's go through in a bit more detail. So first step is ungearing. What we're going to do is we're going to convert an equity beta into what's known as an asset beta. And that means we're going to take out company B's financial risk. So look, we're going to take the equity beta, let's put the equity beta in blue, and we're going to take out company B's financial risk. So what we need to use just here, this is where you use the company B's market values therefore. So look, let's put in a second company B's market values there, and you will find the beta goes down when you take out financial risk. So that's giving you no debt. So it's the business risk only, no debt. Then we can add in our company's debt. So this is our step 3, where you regear. So you add in our company's financial risk. So look, here's the regearing here to give you the beta equity just there. So we regear it just here. So that means what you're going to do is going to take the beta asset there above, you stick it in just there, and for our company, you use our company's financial risk. So this is going to be company A's. We're going to be using here market values. A lot of steps involved. And then finally, we can then put in the CAPM to calculate cost of equity. And finally, last of all, we can then calculate our WACC. So let's now get into that example. Let's go back. So we've done step 1 already. Step 1, look, we've already got here, this is going to be commercial property projects. So let's put in there our step 1, company B. So here it is across last page, and then we're finished for tonight. So step 1, look, we get an equity beta from a company, company B, that undertakes similar business as a new investment company A is undertaking. We saw the beta was 1.59. So there it was, look, you saw here 1.59 at the bottom, just there, look, 1.59. That's company B's beta, just there. So that's our company B's beta, just there, 1.59. Let's put it in. And then what we're going to do in step 2 is we're going to put that beta in just there, 1.59. And then what we're going to be doing just here to this part of the formula is this. We're going to take out, this is going to be company B's financial risk. So look, notice here in the formula now, we're using company B's debt to equity here. Look, we've got debt is the first one, 1. So on the top line, we want equity 2. 2 divided by, this is 2 plus 1, to 1 minus t. And look what happens. When we calculate out this beta asset, what happens here is this. It goes down. And that's what should happen, because look, what we've just done is we've just taken out company B's financial risk. So we have no debt. That would be the beta that we'd be using just here. Because the company's got debt, you can see this is lower because we've taken out company B's financial risk. Now, when you adjust betas I would always use 4 decimal places here. Generally in the exam, the examiner does the same. Now what we need to next do here for step 3 is we now need to regear. So look, let's go back to our steps. We've just taken out company B's financial risk. Now we need to add in our company's financial risk. We need to calculate this equity beta. So again, follow the formula just here. Let's write it out. So beta equity equals our beta asset. There's the beta asset there above. And then look, now what we're going to do, we're going to convert the ungeared beta back into our geared equity beta. So what we're going to do, let's explain what we're doing just here. We're now going to add in our company A's financial risk. So let's do that here first. So let's go back to our ratio of equity to debt. Let's go back just here. So let's go back to company A's. Here's company A's equity to debt here. Look, so we've got debt 2, we've got equity 5. So on the top line we want E, this is going to be plus D. So it's going to be here, look, you can see 5 plus 2, 1 minus T. Stick in the numbers just there. And then look, finally, we should be coming up with another number. So let's put in the 1778 just there. And look, when we add in our company's financial risk, look what's happened to the beta now. It's gone back up. So as you calculate these things, this is what you should be thinking about. Take it out, should go down, add it in, goes back up. But something else important just here is this now. This beta isn't just company A's financial risk. Now, correctly, it represents the business risk of commercial property. So correctly, it represents the business risk of commercial property because we took it from company B originally, remember. And look, let's just have a little comparison here between our beta we're going to use in a second, because look, in a second, step 4, we're going to use this in CAPM. You're going to see just there, look. But before we do that, let's just show the comparison between, look, theirs. Theirs is 1.59. Theirs is higher than ours, because look, they've got slightly more debt to equity. If we do a little ratio, 50%, we've got, look, less than 50%. So we've got less financial risk because they've got more financial risk. Their beta is higher than the one we're going to use. Next, you put it into CAPM, calculate out your cost of equity, and then finally, last of all here, step 5, we can put all this together and put it into our WACC. So last thing just here, let's put it now into our WACC. So there's going to be here our KE. We've got our cost of equity just there. Let's put in our cost of debt, and we want it after tax. So let's go back. Let's pick up our cost after tax early just here. Look, they told us it was 6%. It said, look, where was it? Just here, look, 6%. There, 6% before tax. So corporate debt, although it's risk-free, it's 6% before tax. Let's put it into 6% after tax. And last of all, don't forget for the WACC, we need to be using our weighted averages. So look, for the WACC, let's go back to it. Don't do for debt 2/5 and 5/2. Remember, the WACC is the total, and it's a proportion. It's a weighted average. So look, if we add it up, 2 plus 5, that's going to give us 7. And then for equity, we're going to do 5/7 and then 2/7. But equity 5/7, 2/7. Let's calculate that out, and that will give us just there 11.95%. So finally, let's write it all out now for the examiner. So look, company A's commercial project investment can now be appraised using an MPV of 11.95%, or in other words, that's the WACC. We can use now, that's going to be an appropriate cost of capital or an appropriate discount rate. Now, I think we'll come back to marginal costs of capital next time. It's a concept that they've never tested here, so I think we'll come back to that next time. What I'm going to leave you with is another question here. to practice. So let's turn on. This is going to be here too. This is December 2017. And now come back to this again. So 2 questions we're going to come back to next time. I'm not going to go all the way through all of these questions here, but since they are quite tricky questions, I want you guys aware of the difficulties here. So we've got 2 questions, haven't we? The other question, if I can find it, perhaps maybe I can't find it now. I did keep it out. It's here, look. So look, 2 questions, and then next time we'll come back to these 2. So there was a question earlier about the market values and the discussion, little written question, advising. So should we invest in A or C? We're going to come back to that one, especially that C. That's quite tricky. So I'll have a look at that next time. And then also this question just here. So I've leave those 2 questions there for you guys to practice on. As I said, it's the only way you're going to get good at this style of questions. You've got to practice, practice, and practice.